Here to discuss what we can expect and the implications of a rate rise today and beyond is our finance reporter David Chau in the studio, our senior business reporter Peter Ryan, who's outside the Reserve Bank, and Nerida Conisbee, who's chief economist at Ray White. Welcome to you all. David, let's start with you. So how big could today's rise be?
Well, that's the topic of debate, Ros. So a lot of economists reckon it'll be a standard-sized rate hike, could be 25 basis points, which will signal business as usual from the Reserve Bank. But there's also a pretty strong chance it could be an even bigger hike, like 40 or 50 basis points, which would imply the Reserve Bank is very worried about the high levels of inflation we're facing. So markets are betting rates could rise aggressively for the rest of this year, possibly at every meeting for the rest of this year. And according to market pricing, it could hit 3.5% by the end of next year. So how much rates will go up by will make a big difference on your home loan repayments. So here's a graph that will show you, what will happen if your bank jacks up interest rates. So assuming you're on a $1 million mortgage, you'd have to pay an extra $132 a month if it's a quarter of a percentage point rate hike. But if it's a supersized rate hike, then it's an extra $211 per month. And those numbers are based on owner-occupier variable loans paying principal and interest, or the 25 years remaining on the loan, Ros.
Nerida, to you, do you think the Reserve could decide to hike rates at the upper end of those forecasts because unemployment is so low?
Yeah, so unemployment is sitting at 3.9%. Obviously, inflation is also very low. We won't have a clear read on what the June inflation figures are until the end of next month. I think, as David said, that the call is at the moment is between 0.25 and 0.4%. But it is highly likely that we will continue to see increases throughout the year. We are still low by global standards. If you have a look now in New Zealand, they're sitting at 2%. The US is at 0.75, the UK is at already 1%, and we are still sitting right now at 0.35, although obviously it will increase in a few minutes. Yeah,
and Peter Ryan down at the Reserve Bank. Apart from inflation, what will the Reserve be considering in making this decision?
Well, good afternoon. I think this is a critical meeting, perhaps even more critical than May, because inflation really has taken off. And I think the Reserve Bank Board meeting today face-to-face here at Martin Place at Reserve Bank headquarters have to confront this big issue of surging inflation, already being behind the curve, and perhaps go for that supersized rate hike. And we'll be seeing the outcome in a few minutes, and also their reasoning, which will lay down, I guess, the outlook for what we might be seeing by the end of the year. But I think we can be fairly sure that there could be successive rate hikes in the coming months.
OK, we're still waiting for the official announcement from the Reserve. Nerida, where do you see rates peaking then, and when?
Yeah, look, it is an interesting question. I mean, at this point, I expect them to peak towards the end of the year. I mean, if we look at the commentary around the world at the moment, it is a lot around December being the end of the increasing cycle. Already in the US now, they are talking about rate cuts in 2023. So, I think it does depend on what happens, obviously, with inflation. At this point, a lot of the increases in pricing is really out of our hands. We've got obviously, war in Ukraine is really impacting fuel prices. It's impacting timber prices. China, we've got, a COVID situation there, which is increasing the cost of manufacturing. We've got stuck supply chains. Obviously, an interest rate rise won't fix any of these. And, I think that's the real challenge at the moment. It will sort out activity. It will reduce the amount of activity taking place in the economy. But a lot of these pricing issues really are out of our hands. And the interest rate increases, really won't sort out a lot of them, unfortunately.
Peter, does the Reserve have the same balancing act as the one facing the US Fed, and that they need to combat high inflation? Inflation in the US is higher than here, but raising rates too quickly might affect growth?
Well, that's certainly the big challenge for central banks around the world. In the United States, we've seen the US Treasury Secretary Janet Yellen saying that she really does now believe that inflation's entrenched, and there are some concerns that if the US Federal Reserve does go in too hard with rate increases, that they might end up triggering a recession.
We'll come back to you. David has the the rates now?
Well, Rose, the Reserve Bank has surprised the market. It is a 50 basis point rate hike, so much higher than what everyone else was expecting. So now the new cash rate is 0.85%. So the market was expecting a lower, a 25 basis point or a 40 basis point. But so just to reiterate, is a 50 basis point rate hike, which takes it now to 0.85%. So it's back to pre-pandemic levels, the official cash rate target of the Reserve Bank. So in its reasoning, the Reserve Bank says that inflation in Australia has increased significantly. While it's still lower than in most other advanced economies, it is higher than earlier expected. So it shows the Reserve Bank has continued to be surprised by cost of living pressures and how much they keep going up by. And it has blamed global factors, including COVID-related disruptions to the supply chains, as well as the war in Ukraine, as previously mentioned, accounting for much of this increase in the cost of living. So that's the supply side factors. But domestic factors are also playing a role too, with capacity constraints in some sectors, a tight labour market given the unemployment rates at a 48-year low of 3.9%, and the floods that we saw in the east coast of Australia also having a part to play in this supply shortage, which has boosted prices. So these are some of the key takeouts in the reasoning of the Reserve Bank and why it announced a much bigger than expected rate hike than most people were expecting.
Nerida, are you surprised?
Not surprised. I think, we have, again, going back to how late the Reserve Bank has moved on interest rates and where we are sitting on a global level, it was always going to be a significant increase, whether it was going to be this month or next month. So not exactly surprised. I think it is above the 0.4 in which, most people were expecting, but I guess overall not surprising.
It does smack, though, that the Reserve is playing a game of catch-up.
Yeah, there is an element of that. I mean, I think it's one of those things that it is easy to look back and say, well, why didn't they move earlier? And going back to January, it was an interesting time. The war in Ukraine obviously hadn't, it was obviously heating up. It wasn't at the extent it is now. We also weren't expecting China to go into such a significant shutdown and really impact manufacturing. And then, of course, those global supply chains, really haven't been resolved. So, but certainly back at the start of the year, the view was that a lot of these inflation problems we were having were transitory and would get sorted out once the economy got back to normal activity levels. But unfortunately, a lot has happened since then, which has led to this very high inflation number that we're seeing, and globally these high inflation figures, which we really haven't seen for a very, very long time. So it is unfortunate, but it does mean that, for now we are in a situation of rising unemployment. And as you mentioned earlier, hopefully it doesn't get to a situation where we do force the economy into recession and we do see not only rising inflation because of this situation out of our control, but also rising unemployment as well. Yeah.
Peter, there was a distinct change of language in last month's statement when we had that first rate rise for 11 years. The tone is still the same as that previous one, is it?
Oh, the tone, Ros, is definitely much more hawkish. And in the statement, the Reserve Bank Governor, Philip Lowe, makes the point that it's all about inflation, but the jobs market is very, very strong at the moment, but also making the point that this is the end of the extraordinary monetary policy stimulus that we saw introduced going back to March 2020 when the pandemic hit. And so now that stimulus is being withdrawn. This is a very important part of the context of these rate rises, having had rates close to zero, down at 0.1%, up much higher today. So we can expect more. And the Reserve Bank getting back to the point that they regard as neutral, perhaps being around about 1.6% early next year. But as David Chau mentioned there, financial markets are expecting a cash rate much, much higher, around about 3% in the coming years, and that's going to be putting an extraordinary amount of pressure on households. And interest rates are a blunt instrument. They're going to be hurting households and businesses at a time when cost of living pressures are really eating into household budgets, but there's really no other choice. And the Reserve Bank Board's made the point that they really need to get in front of inflation, which is why we've had this unexpectedly high increase in the cash rate, up half a percentage point today.
So, David, what will this mean for borrowers, especially those who have bought recently and who haven't factored in these rate rises?
Look, Ros, I guess these are the kind of borrowers that will be hit hardest, the ones who, especially if they bought in Sydney and Melbourne, bought in what looks to be the top of the market. So, they, especially for the first home buyers, they're highly leveraged, full of debt, and we're at a stage where it's starting to become, the property market is slowing down a lot. We're seeing, say, in recent CoreLogic figures, the price of Sydney and Melbourne housing, it's declining month on month. So that's definitely not a good position to be in. I guess some of them might end up in negative equity, where the value of the loans they're paying off is worth more than their value of their property. And something I'd be interested in hearing from Nerida is what impact she expects, from property prices going forward. Because a few months ago, the Reserve Bank put out a pretty bleak forecast saying that if they were to jack up interest rates by 2%, that could lead to 15% fall in property prices over a couple of years. What's your thoughts on that?
Yeah, look, it is certainly an interesting market at the moment. We have seen a distinct change in sentiment since the start of the year, when prices really did start to slow down quite dramatically. The pandemic did lead to some very, very strong increases in pricing. Australian house prices rose 30% over those 2 years. If you go somewhere like Sydney, we saw prices increase in excess of 50%. In some suburbs, prices actually doubled over that 2-year time period. So it was getting very, very hot. If we did continue to see those rates of growth, we would have hit a $2.2 million median next year in Sydney, which is clearly is clearly an incredibly high number in terms of affordability, not just for first home buyers, but for upgraders and the like. At this stage, the market is slowing. We can definitely see Melbourne and Sydney slowing. We're not seeing the same slowdown in other parts of the country. So Adelaide, for example, is still increasing quite rapidly. And I think this really does reflect the complexity of housing markets, that on one hand, interest rates are rising, people will be borrowing less. They'll be forced to with a lot of the restrictions that are put in place. But on the other hand, we've got very, very sharp rises in construction costs, and the costs of new homes are increasing rapidly. Similarly, rental rates are increasing very, very strongly. And then we've got population growth coming back. So, more people in Australia will mean higher demand for housing. So, it is a very complex situation at the moment. But for now, I do think a lot of people will feel quite relieved that the market has slowed down, and, it does make an easier market to transact in. One of the comments you made earlier about people that had bought last year and the stress that they would be under, look, there's no doubt that rising interest rates do cause higher repayments, and it does cause a lot of stress for a lot of borrowers. But there has been a lot put in place by APRA to ensure that people were prepared for these rate rises. So there was an interest rate buffer that was increased last year of 3%. So when people went for their loans last year, they were checked to be able to see that they could pay a 3% increase on the existing rate that they borrowed on. So, I know that a lot of people, there will be people that aren't prepared for what's been happening, but, hopefully the message got through last year that, we were in a very ultra low interest rate environment, and they were going to increase at some stage. And, it's happening sooner than a lot of people expected, but it is definitely happening at the moment.
All right, so this is a point where I should...
Yeah.
Oh, sorry, go on.
Peter, over to you.
Yeah, look, I was just going to add to those comments there that the prudential regulator APRA introduced measures to ensure that banks knew that borrowers could withstand a 3 percentage point increase in mortgage repayments. And borrowers are meant to tell the truth on that. Now, I guess people being people, some people may not have told the full truth on that, but it's been estimated by the Reserve Bank there's something like $250 billion worth in additional payments have been made during the pandemic. So there should be a buffer, but there's no doubt that these repayments will hurt a lot of people, particularly when you look at the fragility of household budgets, particularly if someone loses a job or if there's a divorce and that becomes messy. But I think that households should be prepared for more rate rises, and if they're not factoring in those higher repayments now, they need to be doing it.
So, David, what have the markets reacted?
Quite badly, Ros. So since the Reserve Bank decision came out, markets have fallen very sharply. So the ASX 200 has now fallen by 111 points. So that's down 1.5%. So that was a noticeable drop after the RBA decision because there was a bigger than expected rate hike signalling, stimulus is going to be withdrawn quicker than expected. And that's what was boosting stock markets near record highs in the past couple of years because of this, flow of ultra cheap money. That seems to be getting reversed now, and the Australian dollar had quite a little bit of a jump. It's now at 72.2 US cents. It was at the 71.8 US cent mark before. So I guess interest rate hikes do benefit the Australian dollar, that benefit the currency, but then they do have a negative impact on stock market valuations, especially tech stocks, which are considered the more speculative side of the spectrum.
Right, we'll leave it there. Just a reminder of the news that's just happened. As expected, the Reserve Bank has lifted the cash rate, but at the upper end of forecasts, up by 0.5% or 50 basis points to 0.85%. That's the latest from the Reserve Bank. Just leaves me to thank the expert panel, David Chau, Peter Ryan and Nerida Conisbee. Thank you all.